In this game of investing, there are many, many ways to lose. There are many, many ways to win. We are discussing our processes only, so keep that in mind. For those of you that have listened to our webinars before and would like to move forward and build a portfolio with us, please reach out to us at info@nestfinancial.net, and we'll be happy to walk you through the process. I read recently where every one of us knows 150 people on average. So if someone in your circle needs to grow their knowledge in financial area, please send them our way. Send them our webinar links. This is how we introduce ourselves to our clients through our works and our conversations. This is a conversation between our portfolio manager, Sean McDougall, and myself, inclusive of our audience, who can add questions to Q&A. We'd be happy to address them. I do want to specify, if you want to ask about a recommendation in the Q&A, we are not here to discuss recommendations. We can't do that. Buys, sells, that's not what this Nest Edge is about. This is just a conversation. Sean, good to see you.
Good to see you as well.
Let's start off by talking about the newsletter topic, AMC, GME, CNBC, oh my, investigating the narratives behind the meme stocks. This is everywhere, and so it's as we like to do is we like to jump in and talk about all kinds of things in our processes in our Nest Edge. It's a really interesting topic because it is a story of David and Goliath, and of course, who doesn't want the little guy to win? As such, it's easy to get sucked into narratives and stories, and that's what we're here to talk about. Sean, let's first discuss a couple of fundamental facts about the financial industry so we can set up the conversation properly for the audience. You and I have a combined 30 plus years in managing money for clients. There are times that we have differences of opinions about certain investments or positions, and that's normal. We talk about how there are many ways to make money in the market. We are completely on the same page about a lot of areas, and to name a few, or at least one, we're on the same page that story-based investing can be, I use the word carefully, can be detrimental to the investor if you just follow a narrative. As you mentioned in your article, storytelling has a place in history, and it's about how we communicate to our history to the next generation. However, that's much different than putting money behind a story. So that's, again, not on either side of this, and I want to make that really clear. We're not here to say do this or don't do this. We're here to just talk about what can happen and what things you want to look out for. Sean, let's talk about your newsletter.
Okay. Storytelling. Is that my cue?
Yeah, that's your cue.
Okay. Yeah. So I understand where this whole narrative investing started because it goes all the way back. It predates me and you to stockbroker days. So, and I'm summarizing and I'm oversimplifying, but for the sake of time, but you have a narrative, a story of X, Y, and Z company makes this. They're gonna, they're gonna, explode into this big company, and that's what you're doing. You're making a call. You're buying the stock, and then that's what the gate. Like, it's a very old school way of doing it because that's kind of the way it ran for a long time. When you wrote a ticket back in the day, you wrote it on a piece of paper and you put it in a tube, and it was just a completely different world. Compared to where we are today. So making calls because of a narrative is what has been smashed and crammed down your throat probably your whole life. And that's just kind of what people are comfortable with. Like, I can't tell you how often I don't like telling people what I do. Like, if I'm at a round of golf with someone random, because I know what they're going to ask. Oh, what should I buy? What's the hot stock? I'm like, oh, but I don't, it's like, it's such a hard thing to answer. It's just because everybody wants a call. Everybody wants it this stock because of this.
They want that winning tip.
Yeah, I'll ask them, okay, so why? Tell me why. And then having a narrative or a story is it's your thesis, it's your vision. That's fine. That's where the work starts. Just because something could or should happen definitely doesn't make it's gonna happen. Like, you have to go deeper. You have to understand the macroeconomic environment. Is it set up or going to hurt this industry? Is there anything coming through Washington that's going to hurt this thing? And then what's the signal saying? What is the market actually, just because, what that narrative that's on CNBC may already be priced in. It's probably already priced in. Like, if you know about it, it's probably too late.
Well, we
2 days
know,
ago, you were talking about, have we heard anything about Moderna? And I was like, you said you've been hearing chatter Moderna. I'm like, well, yeah, because it's up 17% today because a report came out on it that said it, it may do better than Delta. It's too late. Shit sailed.
yeah, it's already run. Right.
Yeah.
Well, you've mentioned before in your past webinars about CNBC and your feelings there.
Oh yeah, this is maybe one of the best examples. Like for people that don't know, Dan mentioned it. We don't always agree. We agree overall, but like me and Dan, and it's a healthy thing. It's a positive thing. I don't ever take it personally when Dan disagrees with me. I need somebody there to kind of slap me in the side of the head and say, "What about this?" And that's a good thing. But like, yeah. So I'll let you tell the story. But this is a great example of.
I'll save the story for a little later because I think we have that a little later in our queue.
Okay. All right.
Overall, I wanted to, you mentioned CNBC as being trash in the days because they're talking heads.
They're selling. They want eyeballs and clicks.
Yeah, and the other thing that you've said is this holds true of government reports. You've said, you know what, you got to dig in because there's politics involved in this storyline. So you got to keep digging and keep digging and keep digging, even in the government reports that come out. So what we're just trying to say is you have to really, really dig. So our goal as a team is to get to the real data and get the real information and be as transparent as we can, as we know, to our clients. On a personal note, I remember first learning about this early in my career 20 years ago. And I was completely shocked that we can't rely on news media. Imagine me, straight into the industry, just passed my test and getting in here. And then other advisors telling me like, CNBC, no, you can't trust that. It's got to spin. And they pointed out that look at money magazines, look at all these magazines, look at who the advertisers are, and now look at the stories. And so you start seeing where it started making sense to me, like, oh my God, they're skewing the stories based on who's paying them. And that goes all the way up to actually ownership of companies. So I was a little bit heartbroken 20 years ago to find out that here's this, imagine this, I came into this industry because of CNBC, not because of CNBC, but because of the channel. I saw these things that were crossing across the TV, and I'm like, what does that mean? What do the tickers mean? I did not know. And it was curiosity that got me to study, got me to learn. I wanted to unfold this thing, and it was that channel. So you can imagine my heartbreak whenever I realized that there's a spin. So when you dig further, figure out who owns the media company, you get a better understanding of how stories are influenced. Now you fast forward to 2021, and it hasn't stopped. There's literally, it's actually increased. And we see this not only in media, financial media, we see it all over the place. Now you add social, and you have millions of people putting up opinions, and it's even much less reliable in a lot of ways. It is definitely a two-edged sword, and so that's what we're talking about.
Yeah.
So, Sean,
I don't know how to unpack that. I want to talk for a day for that. Did you want me to dive in there, or are we going to move it on?
No, let's move it on. Let's break down the news media. What are your thoughts on them? Like, what is the first thing that comes up when you're thinking about news media?
If it's free, there's probably a reason. Like news media, are we talking like CNBC, Bloomberg, and all of that? Yeah, it's on TV.
Are they financial professionals writing these stories? I mean, that's what I've heard you say in the past.
No, most like the articles themselves. If you run the reports on them, they're journalists, and they reach out to people that they'll source other people, but they're not. Sometimes they'll throw opinions in there. Or my favorite is if like Downtown Josh Brown on CNBC. If you look into that guy's history, he's a joke. He just somehow wiggled his way into media, and he's making more and more money than that. Like my favorite thing to do with anybody that makes a bold claim out there is say, okay, what have you said before? What did you say 5 years ago? Back check these guys, because if you're just saying trash, and then one hit's fine, trash. If I want to see your track record. Like that's the thing that like I hammer out. Like I've been like, I know you think, and you're not wrong. Like I probably love Hedge Eye too much, but like I watched them like a dog for a year before I did anything with them. That's what you got to do. You got to say what was your worst idea? Like what went wrong? When did you get it wrong, and why? That's what you got to do with any research provider or anybody tweeting or anybody on Reddit. Look into that guy. You're not on Reddit, you're not going to get their name, but you can see what they've done before. Right. And then kind of say, all right, 2 years ago you said X. How did that play out? No one's ever going to be right every single time, and things can go sideways. But with the crystal ball, everything looks obvious. But
exactly. It happens in politics. It happens in financial media as well.
There's no magic bullet. Anyone that says they figured this game out, it's like, you're about to,
you better run the other way.
Or their name is Bernie Madoff. I mean, it's one of the two.
So the point is, I think the main point, and what we're all trying to say is here, we're both trying to say is making decisions based solely on that, solely on a tweet, solely on a CNBC report.
So dangerous.
It's no longer an investment. That becomes a gamble. And there's all along, going back to the guys looking for a tip on the golf course, that's a gamble. They're just looking for the easy, give me the answer. I don't want to do the homework. And it's in the homework that you find things. And this is an important distinction. I've always said there are many, many ways to make money in the market. We have a process. Our process and our commitment is simple. We buy-vetted research, as you pointed out. We commit to clients to take on the least risk possible and get them the return needed for the objectives. Most of our clients are retired. It's our responsibility to serve them and see that the investments they're in last in their lives. So it's a heavy weight that we have. But other people in this industry, other firms, can take 100% different approach. I'm not saying right or wrong, it's just different. Can you talk about hedge funds for a bit? Like, talk about how they do things and how the rules for them are different than ours.
Yeah, it's easy. They can do whatever the hell they want. I mean, that's why, believe me, like the idea of doing a hedge fund sounds kind of nice because there's zero regulation. You can do what I could buy anything. That's where a lot of the fraud stuff kind of creeps in because they're not watched. There's certain checks and balances, but really not. I mean, they can kind of do whatever the hell they want, and that's why they're only there for accredited investors, for extremely a lot of pensions, a lot of high net worth individuals. They're the only ones that are supposed to get access to that, at least directly.
It surprises me because it's like your high net, worth individuals, accredited investors, and pensions. Like pensions should be really super safe, but
I mean, they generally the pension advisors, the guys that are ultimately there's usually a board of people per pension, and they choose which funds they invest in, and they're generally very difficult to get in front of because they have everyone chasing them. I mean, they don't just invest $1 million. They invest in $1 billion increments with different funds. So they're hard to get in front of, and they're demanding, but their money should be the safest thing possible. But at the end of the day, they just want returns. They want money. They got to, most pensions are way underfunded. So you got to perform.
There's pressure there. Yeah.
So much pressure. You got to perform. Like if we lost $1 million client, that sucks. But what if we lost $1 billion client?
Right. Yeah.
That changes your business.
100%.
It's just 100%. A different game. So hedge funds will cheat. They will cut corners. They will do insider trading. They will do whatever they can. There are some that play by the book, but a lot of them
and we know that being in the industry for all this long, we see it, and it's there's so much about this industry that's like, okay, we have these rules, they have those rules. It's
insider trading. It definitely happens. It's a thing. It's extremely hard to get caught on. So people are going to do it. I mean, it's just so hard. I'll see it every now and then in certain positions. You're like, why the hell are bond yields ripping or gold ripping in one way or the other? And then the next day, some news come out okay, news leaked. Somebody sent somebody a text. If there's anything that's real weird, volume rips, and okay, am I missing something? And then it's like, oh yeah, I didn't go to college with a CFO. That's what.
You didn't golf with the right person.
Maybe I should talk to people more often on golf courses. I don't know.
So diving into AMC and GME for a bit for our clients that haven't followed the story, here's a story as you pointed out in your newsletter. The story is that hedgies took a gamble to short these stocks, meaning sell stocks they didn't have, based on information they thought of the stock being overvalued. I mean, think about this. We were in 2020, pandemic was going on. They bought these companies they thought were going the way of Blockbuster. So they shorted and essentially to drive them into bankruptcy. So I have a question just for us to explain to the audience. How do they make money on this move?
How do hedgies make money on it?
On a short going down, like when the company goes belly up.
Well, if it's so what a short really is you're buying an option contract, and you have the right, not the obligation, to execute that contract. And depending on which side you're on, they become more valuable if the price goes the way that you're betting. So if you're short the thing and the value of that contract goes from $10 to $95, that's, the real value is like people, like it's when you go out and you buy puts or sell puts or whatever, you're buying a contract to execute something, the option to execute. So that's where the options come from, because it's not required. Futures is the required part, but that's another market. Options, you have the option to execute or not execute it. You can let it expire. And I know I'm getting too deep in the weeds here, but the contract that you're buying, if you're shorting something, it goes up in value if the price goes to the floor. So let's say you bought those put options 6 months out at XYZ price, and the price goes to zero. You bought those put options at $10, and now they're worth $100 a pop. Doesn't take an econ major to add that up or anything. It's, they become extremely valuable if you guess the right direction. Now, the AMC one, that's there's layers to that. I get the rationale on both sides. I think AMC won the most out of all of that because they issued hundreds of millions of shares into that their price going up. GME is a more valid story. There is some layers there to where it makes sense. We were long GME for a while. We got in at like 12 and then sold it. God, our more aggressive people made so much money on that one. I think we sold out of that a dozen times and then finally got completely out at like 185 a few weeks ago. The board, the executives taking that thing over. Now, is it at 185 or 160, whatever it's trading right now? It's a little high, but people get caught up in what's called PE ratios as well. Like, oh, it's too expensive. Oh, it's too cheap. Cheap gets cheaper all the time, and more expensive gets more expensive all the time. Trading off what's expensive or cheap is just as dangerous as trading off narratives. You can't have a single factor model. You got to look at all the pieces in the puzzle and put them together and then decide, depending on what your strategy is this makes sense? Does it check this box? Yes. Does it check this box? Yes. Does it check this box? Yes. Now it's interesting. Then the work really begins. Like making any decision, and I'm rambling.
Yeah, no, I want to explain because we've got all types of people in the audience. We've got people that
I ramble.
You don't know me. I didn't want to get into like positions that you've done or we've done for portfolios. Understand that the portfolios that we manage, once again, have certain objectives to manage risk. It does not mean that tomorrow that doesn't become attractive again. So I just didn't want to get into the ins and outs of that.
Sorry.
I did want to talk about, essentially, the question is how do they make money? And the idea is if you're betting on these things to go down to the ground, you can make money if they actually go down but you're out money if they go up. And that's where it becomes a bet. I'm betting that these things go down. Yeah. And so
you can lose but the thing is, all these people where the hedges really got crushed is they weren't just buying with the money. They're buying it usually with leverage.
Right.
And that's when you get, if you're short something on leverage and then it goes against you, like Bill Wang, that's a great example. Maybe the best example of all time.
Well, of course, as you do this, there's, when we talk about, this is obviously some of this stuff's not legal because there's, you don't own the stock and you sell it, and it happens all the time, as you mentioned before. And of course, you do that. There's zero barrier to entry as far as, when you start thinking about people talking about this all online and giving their opinions, and what I'm saying about other people on anybody on any of the social medias can just say whatever is on their mind, and if they're not providing any type of background or thesis, and also here is the proof, then it does become a gamble. So what the whole point of all this is, let's just check our sources and make sure where the information is coming from, and before.
Did I ramble too much today?
Yeah, it was just threw me completely off. I was like, we weren't even talking about that. Man.
Sorry, you threw up there. Yeah, that's my bad. I out rambled you today.
You did. I normally try to but now you just went off this whole layer. I'm like, oh, what's going on here?
Bad.
It's just like
I don't.
Thing.
Yeah.
The point is, I follow stories on social, and because my perspective is a bit different. And Sean mentioned that we have differences of opinion, and we talk about this stuff all the time. I was 7 to 8 years into my financial career when I was blindsided, like 99.9% of the world, about the housing crisis. So I've lived through a few things. I've lived through the Bernie Madoff. I've lived through the Enron. I've lived through, the housing crisis, and as an advisor. And so as you're dealing with this and trying to find out what that real data is and trying to communicate with clients, luckily during the housing crisis, I made some protective moves that beforehand saved account values for our clients at the time. But I mean, luckily, I remember feeling betrayed at the time. I remember feeling that, in the industry, I should have seen this sooner. And it was at that point when I realized how a retail advisor, we're really way down the totem pole, right next to retail, when it comes to things that are happening on Wall Street. So we have to pay a lot more attention. So the data that I had at the time didn't reflect what was really going on. So now we do spend a lot more time on data that we do for clients. I don't want to be caught in that situation again. So besides main information and data that we pick up, and a data provider, I rely on you to sift through the information. I turn and sift on information on social to see if there's any sketchy information out that may be some truth to it. And the reason I do this is just by like whistleblowers are out there. There may be information that turns out to give us advance notice on something that isn't flowing through the regular reliable channels. But I do sift through that information like sifting through gold, right? Meaning that the majority, like what you pointed out earlier, the majority I ignore. However, when there's something that's reliable sourced, I further research. And when you look at historical impacts, you think about who discovered the things that brought the houses down, right? You think about Sharon Watkins, who was asking questions that discovers that Enron was a house of cards and brought the biggest company in the world down. It was one person. You look at 2008, and there was only a small number of people that did the work, did the nitty-gritty. They went out there and did the data discovery and called it, and they made money because they were on the other side of that. So for me, it's important to look at that, sift through it, follow the data, and I keep digging. So I'm still digging on AMC and GME, and I keep asking questions and keep digging there. So that's really important. So speaking of data, I want to quickly shift on this. We've got like 7 more minutes. There's a lot of market buzz, Sean, on market highs, inflation, hyperinflation, gold falling off, this weekend. Can you sum up what the data is telling us right now about general markets?
I mean, inflation is rising, depending on how you define it. That's no matter how you define it, it's rising. It's probable it's going to continue to rise. I mean, the easy money this year has probably already been made. The first quarter was when a lot of things haven't been priced in yet. I mean, how close we are to the top, I have no idea. I mean, I know what's probable in the next 3 weeks, but this number is constantly. Too many people out there like to say, "Oh, the top is at 4,700," and I expect it to be. No one knows that. I mean, I like right now live. We think it's probable the next 3 weeks. As of right now, there's another 50 bips of upside in the S&P 500. Like it's at 44. That's creepy. But when the price, volume, and volatility are constantly moving, like that, those tops of those ranges are constantly kind of pinging around. But as of right now, I don't call bottoms. I don't call tops. I just follow the process. What's the most probable place that we are in the trading range? Looking at price, volume, and volatility. I think I did not answer all of that question.
I just kind of give a general where we're at in the market.
Yeah, the second half's going to be harder. Domestically, the second half is going to be harder compared to the first half of the year. Europe has more runway than we do. China, Asia, and Japan are going to be a bit of a mess for a while. Gold got hammered recently because the jobs report came out hot. That was a classic example of insider information because gold started falling apart like Thursday, like Wednesday, Thursday. Gold is on my radar to start buying into it. And that's what I view this as was it was a buying opportunity for some of our more aggressive models. But you got to be careful because there's certain economic things. So like we're getting too far into the weeds and I know this, but like gold it's not for sure guaranteed a layup moneymaker. It's for more aggressive models. We're starting to fade it in. But that's what, very simply, and then I can't say this enough, very simply, think of it as like the jobs report came out, it looked great. We thought it would, or we thought it was probable that it would. We don't know anything. And it came out great. So people were like, oh, why am I in this safety of gold over here? Let's get out of it. And that's what kind of that pop.
Right.
And it got oversold, and it's up today, I don't know, 1% or so, which for gold is a lot.
Nice. Well, let me wrap up a couple things. I know we've got a couple of questions from our audience. Mark, I see you. I know that you're asking a bunch of questions around GME and AME and manipulation, dark holes, naked shorts, all of that. The main question that I want to be able to answer is that we're short on time, and I hear you, and we can always.
Sorry, Mark, that's my fault.
Emails. The main question that I want to answer for you is who can be held responsible for the current manipulation, dark holes, naked shorts, and how do we enact change? In 30 years, Mark, the only way that I've ever seen, 30 years, 20, I've been 20 years in business, combined with 30. The only thing that I've been able to see is reach out to officials, because at the end of the day, it's all of these institutions doing their own thing, and quite frankly, they get their hands slapped, they get put out of business, all that kind of stuff, but it has to come from the top. So I'd say the main thing is SEC's out there doing some things. I've seen a lot of, even though you see in Twitter and social and Reddit, all this, where it's like it seems because there's emotion involved with money, and it seems like SEC is not moving at all. There's a lot of things that are being done. I see it from a pace of a professional. You see, you're like, okay, that's getting done. Check. That's getting done. Check. That's getting done. Check. And so I think the gears are moving. It's just not moving the pace of social at this point in time. But how do we enact change? Keep pressing. Keep sending messages to SEC and your suspicions and what you see. So send the proof, not just a rant. And I think that's the biggest takeaway there. Yvonne, you want to know more about investing in general? Sorry, that's such a long topic for this. But
you want me to get started on that?
No. I do encourage you to reach out to us directly, or just follow us on these webinars. We do, or look at our past ones. We have all on our website. We do provide a lot of guidance about investing in general and what our opinions are. Bottom line, at the end of the day, we don't recommend gambling. We know the house, as you know, typically wins. Wall Street can be a casino. It's not supposed to be. And it turns out when you don't do proper research, it becomes a gamble. So as you point out in your newsletter, Sean, research, dig in, data. We're not saying one thing's right, one thing's wrong. I don't want anybody to take that away from here because we made a decision for a portfolio doesn't mean we're not going to get right back into it just because we are looking at data daily, right? And so don't make your decisions based on this. Keep digging, but check your sources. I am proud most of what I'm seeing following in social is the interest that people are taking in their financial future in their hands. It's really impressive. Along with that, exposure that comes out, sunlight comes out, you shine the sun on something and exposure comes out. Whether the answers or conclusions are right or wrong, it actually comes out. So the questions that retail investors are asking are significantly upping their knowledge on how things work on Wall Street, and I'm really proud of that. That makes me very happy. I myself, after being in the industry for 20 years, I'm also learning things that I had not learned about or not focused on before. So the knowledge can always increase.
It never stops.
So keep this search of knowledge. It's great. And for the millions of people that are looking, keep going, keep searching. We saw some things, and we are just about out of time, so we're not going to get into what we saw on CNBC, but there were some things that were just manipulated on CNBC.
Oh, we had to tell this story. It's too good not to tell.
Go ahead. Okay,
so the head of the SEC was on, Dan was telling me the head of the SEC was on CNBC talking about, how the dark pool thing, and they're going to start clamping down on that. And I saw that and I was like, okay, I know who the head of SEC is. He's an old Goldman guy. I'm like, I'd be interested to see how clamped down he's going to be. And so I hopped online to kind of find that little thing to see what he said. And the only thing I saw him on there was talking about crypto. And I was like, Dan, he didn't say anything about that. It was just all about crypto. And then Dan's like, what the hell? He went and dug into it. And I guess Goldman guy, he tweeted what the full interview, what he did. CNBC took the interview and then cut off the part about the dark pool stuff and only left on there the crypto stuff. Like they framed the conversation big time. Like it was like, I mean, that's the best example. I couldn't even make that up. Now they're going to frame their narrative and what they're trying to do, which right now, crypto is the hot, it's the new hot girl at school right now, and everyone's excited about it.
For sure.
I told that as fast as I could.
Thank you very much. We're 1 minute past. Thank you, everybody, for joining us and attending the webinar. We have these every month. We actually are creating a podcast YouTube channel to start diving into more of these areas that need more investigating. We aim to continue to shed light on things that we have questions about, and hopefully bring on guests that can shed more light and give more answers. Stay tuned for that. We want to be professionals in to give them that professional light on the thing and ask those questions. And of course, we want to talk to people that we've been following, like Trades, Charlie's Vids, Houston We Have a Problem, Peter Hahn. We're hoping that we can get them on the show and start asking these kind of questions and really dig into some of that with, again, more professional tone and kind of knowledge that we have and we can bring it on the table. Again, this isn't investment advice, rather conversation between how we do things and what we look at. Think of this as education in nature. And we hope you enjoyed the commentary today. And if after this you want a recording, just send something one will be in your inbox. Thank you very much. Have a good day.
Adios.